What's going on, guys? It's Jimmy. If you see my video several days ago that on March 20th, the Fed was making a big announcement, and they did here today. It actually sent the stock market into a frenzy, and I'll give you the details here on that here in a moment. I'm going to let you hear directly what the head of the Fed, Jerome Powell, here had to say, some highlights of what he had to say, and the impact of that going forward. This will impact millions of Americans, almost the whole country, with interest rates, credit card interest rates, mortgage interest rates, auto loan interest rates when you go to buy a car, lease a car. This is going to affect pretty much the whole country going forward for 2024 and beyond, because when they tinker with interest rates, it affects the job markets, the home markets, real estate, credit card interest rates, pretty much almost the entire United States. So take a listen to what he had to say here, and then I'll break it down in layman's terms, and the path forward is really what matters here. So take a listen here.
My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made considerable progress toward our dual mandate objectives. Inflation has eased substantially, while the labor market has remained strong. And that is very good news. But inflation is still too high, ongoing progress in bringing it down is not assured, and the path forward is uncertain. We are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustainably strong labor market that benefits all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. GDP growth in the fourth quarter of last year came in at 3.2%. For 2023 as a whole, GDP expanded 3.1%, bolstered by strong consumer demand as well as improving supply conditions. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have weighed on business fixed investment. In our summary of economic projections, committee participants generally expect GDP growth to slow from last year's pace, with a median projection of 2.1% this year and 2% over the next 2 years. Participants generally revised up their growth projections since December, reflecting the strength of incoming data, including data on labor supply. The labor market remains relatively tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 265,000 jobs per month. The unemployment rate has edged up but remains low at 3.9%. Strong job creation has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration.
So I'll get to what they're saying here about interest rate cuts coming here in a second. But if you notice what he said there, that what they're doing is planned, and that the higher interest rates are putting downward pressure on the economy and inflation. This is planned. They've been doing this for a while, and higher interest rates are putting downward pressure on growth and inflation. Okay? In theory, when interest rates are higher, when credit card interest rates are higher, when mortgage interest rates are higher, and we've seen this in the mortgage rates, people don't rush out to buy homes as much, which stifles the real estate industry. And same thing with credit cards. When credit card interest rates are high, people don't rush out to buy TVs and buy anything, right? If iPhones, anything, right? Just think about it. You don't rush out to buy things as much when interest rates are high. This brings down inflation, okay? When interest rates are low, people buy things more. This is kind of the Fed Economics 101, okay? And this is what they've been doing. This is why when you raise interest rates, inflation comes down slowly, okay? When interest rates are low, inflation can creep up. So this is what they have been doing over time. However, when interest rates are high, people with debt suffer more. And this is also the effects on the economy that have been going on right now. Okay, and typically lower income people with debt tend to suffer more. So this is why if you can pay down your debt, pay down your high income debt, you will not suffer as much. So pay stuff on a cash basis. If you're going to buy food, pay it on a cash basis, or pay your credit cards off on a monthly basis, and you will not pay interest. Let me know your thoughts here in the comments.
We believe that our policy rate is likely at its peak for this tightening cycle. It will likely be appropriate to begin dialing back policy restraint at some point this year. But inflation is still too high. Ongoing progress in bringing it down is not assured, and the path forward is uncertain. We tend to see a little bit stronger, this is in the data, a little bit stronger inflation in the first half of the year. I don't think we really know whether this is a bump on the road or something more. We're looking for data that confirm the kind of low readings that we had last year. My instinct would be that rates will not go back down to the very low levels that we saw.
We also have here from the Fed, even though we left interest rates change today, this was actually good news because there was some people that thought that they might raise interest rates here today. The Fed says that there's still 3 interest rate cuts planned. This was good news. And so 3 interest rates cuts still planned. And this sent the stock market into a severe rally, with them reiterating that there are 3 massive, or at least 3 interest rate cuts planned going forward, which will be good for everybody. And so it's also good for people with money in the stock market, IRA, 401k, people with retirement funds, and good news for people going forward thinking, yes, we will finally see sometime, hopefully this year, interest rates coming down. Credit card interest rates, mortgage interest rates, personal loan interest rates, business interest rates, all type of interest rates coming down. This is what they said, indicating the 3 interest rates coming still this year. This actually sent the Dow Jones stock index to almost 40,000 for the first time ever, which will, obviously be a milestone, which is wild to think 40,000. I remember when they were talking about Dow Jones 20,000. Now we're going to be at Dow Jones 40,000, which is wild to absolutely say that. Just to think that back in 2010, the Dow was at 7,000. Now it's going to be at Dow Jones 40,000. Absolutely unbelievable to even think that. Let me know your thoughts here in the comments. The problem here is inflation right now and interest rates, because, interest rates went up, not just here in the United States, almost pretty much everywhere worldwide to try to bring down inflation, which went up pretty much worldwide. And, they're hand in hand. So, if they didn't raise interest rates, inflation would be even more out of control in the US and worldwide. So they raised interest rates to try to curb spending. So people just, that was, one of the main reasons why inflation was up worldwide. And, it's catch-22. And these are the problems that, we're trying to deal with right now. You can let me know your thoughts here in the comments. But, Yeah. So I will keep you up to date. If you haven't yet, subscribe down below. Click the bell icon so you don't miss out on new videos. Thanks for liking and sharing. Click here to see the big announcement the White House just made. Thanks, guys, and I will see you in the next video.